Hey guys, what's happening? Eric here, Mr. Fired Up Wealth. Hope you're doing great. I want to bring you a quick video today. I've had a lot of questions recently from friends and from people just within the Fired Up Wealth group asking, if you were to start a portfolio today, if you were to start a portfolio right now, what would you buy? And I own a lot of the stocks I'm going to cover today, but I actually spent a couple of hours because it's something I like to do. And obviously being kind of locked in at home, there's lots of extra time. So I spent probably 2-3 hours working through this and thought different scenarios out and said, if I had, this much money and I was this age, what would I buy to build a portfolio that I think would be a perfect growth portfolio? So I'm going to do that today. I'm going to show you what I would do if I would literally had a sum of money that I was going to put to work today, how I would allocate my assets. So first, some assumptions, because this is not going to be one size fits all. Nothing ever is. And you might need to make some tweaks to make it work for you, or you might decide that this, isn't for you because it doesn't fit with your risk tolerance, your suitability, et cetera. But first of all, it's best for younger investors. So young can be subjective, but, usually, maybe 45 or less. And, obviously the best fit's probably going to be someone in, 35 or under for something like this. Assumes a balanced approach, but aggressive balanced approach. So it's aggressive growth. It's not the most aggressive you could possibly do, but it's pretty aggressive. The reason it's not the most aggressive is because there are some ETFs and some DGI that are much safer than some of the hyper growth, high flyer type stuff. And I'll get into that. It definitely has risk reward. Assumes at least 100K portfolio, but don't worry if you don't have 100,000, just reduce the number of stocks, and you'll see what I mean in a minute, because the amount of stocks won't make sense if you have a smaller portfolio, and that's all it is. So just setting some ground rules, some assumptions so that this makes sense. Otherwise, you try to put it, into a $5,000 account and you say, well, this doesn't really make sense. It's not going to make sense on a $5,000 portfolio because there's a lot of moving parts to this. It can be tweaked for your needs. And again, if I were starting today, this is what I would build, and it'd be something I'd hold on to for at least 5 years, preferably a decade. So we're going to build with pillars and percentages. And this is similar to the whole fired methodology. It's similar to what I'm doing now, but this is actually a little bit different because I'm close to the end game meaning, retiring off dividends. And so my allocations are going to be different than what this is. So this, again, is for somebody that has maybe a 10-year horizon that wants to be aggressive, that's young, young enough where you can take some risks and you've got time on your side. We're going to do a blend of ETFs, stocks, dividends, and cash bonds, CDs. How do you know what blend to use? I'll get into that. How do you know what percentages to target in each bucket or each pillar? I'll get into that. And I'll provide you an example, again, of what I would build if I were starting today. So if I had money and I were putting it to work, I would put 25%. Again, this is an aggressive growth portfolio for a younger person. So it's not one size fits all. If you're 60 years old, this isn't recommended for you. 25% in ETFs, and the ETFs that I'd stick with in this situation would be the triple Qs. I'll get into that in a minute and explain what are in each of these ETF baskets. An ETF is just a basket of, a holding of stocks. So the QQQ, that's the NASDAQ 100 that I've talked about, a bunch of my other videos. The VU, which is the Vanguard S&P 500, and then DGRO, which is a dividend growth investing ETF for my shares. Then we're going to do 20% in DGIF. What's DGIF? That's dividend growth investing for fired. All that really means, guys, is total growth. So you're looking for dividend growth investing, but not just, something that grows its dividend. We want a stock that grows not only its dividend, but also has appreciation in stock value. So you're getting growth on both ends. That's what DGIF is all about. I have an entire series that covers my top 60 DGIF stocks, and it breaks it down by sector. So if you're interested in a specific sector, you want to check out that series, I'll leave a card up and you can take a look at that. But you should pick 20% in this scenario that we're doing today. We're going to do 20% DGIF, and that's going to be about 10 to 25 individual stocks with about 1 or 2% of the assets, per holding. So let's just break this down, simple math. So if you had $100,000, you put $25,000 into the ETFs that we just talked about on the last slide, and you can break those down equally, a third of each. DGIF, you're going to have 20%, which is $20,000. You're going to buy, say you buy 10 stocks. Obviously, it's $2,000 per stock. The bigger portfolio you have, if you have $1 million portfolio, it might make sense to have 25 individual stocks versus 10. And so you can scale that accordingly. Stay tuned for my picks. I will show you actually what picks that I would pick today out of this 20% bucket. Next, we're going to have 40% in growth, and that's going to be another 10 to 25 individual stocks, depending on the size of the account, between, say, 2 and 4% per holding. And again, stay tuned. I'm going to actually give you a large list of growth stocks that I actually own, and then some that I don't own that I would actually buy right now if I were, building a portfolio from the ground up. 10% spec. My channel has a few different videos on speculative stocks. Those are stocks that are basically very, very high risk, high reward. They might triple, they might go to zero, they might go bankrupt. So spec is 10% of your portfolio. You're just kind of rolling the dice on these. And you've got, say you've got $100,000 again. Now you got 10 grand, which is, 10% in spec. You're going to do probably 10 individual stocks with, $1,000 in each holding. And then cash, you're going to have 5%. You want that to be liquid. So it can be cash, it can be a bond fund, it can be a money market, a CD, anything that's liquid though that you can get to right away. So if you're with Fidelity, for example, there are different funds that you can put into where it literally is liquid. So I might have 10,000 or 50,000 or whatever in my cash sweeping account, but I can use that cash instantly, liquidly. I can cash it out, send it to my bank account if I need to pay a bill or if I have an emergency, or I can go ahead and buy a stock with that cash that's in there. So it's liquid. I'm going to use that for dips and for any bargains. If, a stock looks beat up, maybe it's a knee-jerk reaction to something like an earnings report, you might say, hey, I want to add some to this position that I already own. That's what that cash is going to be there for. And you're going to shave profits to keep that cash allocation. So, when the market gets to all-time highs again, you might want to sell, some of the stocks that are at 52-week highs and you think that they're, get a little frothy, a little overpriced. You might shave a little profits and put that into your cash position. And that's how you keep that cash moving. So what does this look like? Here's my beautiful handwriting. 25% in the ETF with the Qs, the VUs, and the DGROs. You got 20% in the DGIF stack. You got 40% in the growth bucket, 10% in spec, and 5% in liquid cash. Okay, it's going to give you obviously 100% pie. So let's get into the picks. What would I actually buy? Again, the ETS VU. This is going to give you some of the top holdings for each one, and you're going to see there's some overlap, and that's okay. The reason I like these is they have very different expense ratios. They've got different dividend payouts. For example, a VU is around 2% for your dividend yield, where the QQQ is going to have more growth. It's more tech-oriented, and that only has a 0.75% yield. And your DGRO has, closer to 3% yield, depending on what you're looking at. And you can look at this and say, well, all three of them have Microsoft the top holding. That's okay. That's totally fine. It's a great company. You could buy 20%, you could put 20% of your assets in Microsoft, and I would sleep just fine with that situation. So Microsoft, Apple, you can see Microsoft, Apple, Alphabet, Amazon, the FANG stocks, they're going to be in VU, they're going to be in the triple Qs. The difference is when you look at the triple Qs, it's going to have, some things like NVIDIA. NVIDIA is up here. Netflix is up here. If you look at the VU, Netflix and NVIDIA aren't in there. The Microsoft, the Apples, the Alphabets, the Amazons, the Facebooks, those are kind of across the board. When you get to DGRO, Verizon's actually the second holding because Verizon's paying a 5% yield. So this DGRO is trying to give you some dividend growth, right? So it's got Johnson & Johnson, JP Morgan, Chevron, it's got Pfizer, Wells Fargo. You can see Cisco, I think, on all three of them. Cisco here, Cisco, triple Qs. It's way up here under Pepsi. And then the VUs has Cisco as well. It's just obviously not in the top holdings. All right, let's get into this. So for the DGIF, what am I going to put into here? So I've got this broken down into 6 different buckets. It's really, energy and utilities I kind of have together. But for the financials, and again, I've got a whole series. So I've got a financials DGIF video. I've got a healthcare video. I've got a tech video. Each one of these red subject lines or categories has its own video if you're interested in digging into these more. Financials, JP Morgan, and I'm going to buy some Bank of America. I'm going to buy some Visa. I'm going to buy some MasterCard. Now, if you've watched my other videos, you know that, I explained that Visa and MasterCard are technically they're technology stocks, but I put them in the financials bucket. That's just how I do it. So from my financials, I got the 2 best quality banks, in my opinion, JP Morgan and Bank of America, and the 2 best, fintech stocks, which are obviously DGIF that pay a dividend, have dividend growth. Even though the dividends are small, they do have dividends and they continue to grow their dividends. So we got healthcare. We're going to do United Healthcare. And in my opinion, that's the strongest dividend growth investing healthcare stock that you can put your money into. AbbVie's got not as much growth, but it has a very solid dividend, between 6 and 7% dividend yield, I believe, right now. There is some risk with all these stocks. You look at AbbVie, they've got, with the Botox, people are, not doing those type of surgeries right now. The hospitals and things are closed down. So that's going to impact the stock, but I think that's priced in, and I think the dividend's still safe. So I've got AbbVie in there. It's going to give you a nice, yield and some growth, but it's definitely not a growth stock. CVS I also like in there. Nice dividend yield. And I really like, I like the acquisition that they recently did to kind of branch out in healthcare a little bit. Technology, you're going to have Apple, of course, Microsoft, NVIDIA, Lam Research, Skyworks Solutions. That's a 5G play. So Apple and Skyworks and even Lam. These are Lam Research is going to be LRCX is Lam Research. That's going to be semiconductor equipment. SWKS. Skyworks, that's going to be the chips that go into the iPhones. It's going to be a huge super cycle for 5G. Activision Blizzard, of course, people are staying at home. They're playing more video games. And that's another, lower dividend, but it does have good growth and it does have dividend growth. I've got Cisco in here. It's beat up really bad. And this one is a bonus pick when you look at DGIF, but it does have a very solid dividend yield over 3%. And I think you think of, their WebEx, people are using WebEx more. They're getting more into security. And then you've got the whole 5G super cycle with equipment. And I think, Cisco's one of those that's going to get beat up, in an environment like this, but I think it's going to come out on the other end and do just fine. It's got a good cash position. It's, not going to go out of business, in my opinion, anytime soon. So I've got Cisco on there. For consumer and consumer discretionary, this is going to be consumer discretionary and consumer staples kind of mixed together in one bag. Nike, Domino's Pizza. Of course, people are ordering more pizzas now, and they're great at what they do, and I've covered them in several other videos. Home Depot, best of breed. Costco, no brainer there, I think. So energy and utilities, you got NextEra Energy and Xcel Energy. I won't go into too much detail on those, but those are 2 decent companies that have dividend growth that I would look in, to in the energy and utility sectors. Industrials, you got Roper Technologies, which is more of a tech play than anything, but it's technically in the industrial space. If you're interested in learning more about that, I have about a 10-minute conversation just on Roper Technologies in my DGIF Industrials videos. So take a look at that one. Lockheed Martin, great company. Honeywell, they're obviously Lockheed Martin and Honeywell. They both have aerospace, and that is, anything airplane related right now is not doing great. But they've been beat up, and they're healthy companies. They have a lot of defense work, government type contracts. They're not going anywhere. And then LHX, this is one that, I've liked for a while, another aerospace and defense. So you might choose not to do all 3 of these. LHX is L3 Harris. You could maybe pick, just one or the other, but I personally like all 4 of those in the industrial space. So let's get into the growth buckets. This is 40%. What would I buy? If I were going to buy some stocks and build a portfolio from scratch, and I had a bunch of cash, what would I buy for 40% in my growth bucket? Amazon, of course. If you follow my channel at all, you know that Amazon is my top holding and it's my favorite growth stock. It's not, doesn't have the highest, reward possible, but I think it has very high reward with limited downside risk, especially in this environment. ServiceNow, if you're interested in any of these stocks, just subscribe to my channel because I talk about SaaS and cloud and 5G, and I'm very growth, everything I cover for the most part is either, hyper growth, high flyer stuff, or it's going to be dividend growth investing, but it's going to be DGIF. So it's going to have, dividend, but it's going to have growth in there like NVIDIA and things like that. So ServiceNow, Salesforce, Splunk, just did a video recently on Splunk, Workday. These are all SaaS and, cloud plays. Paycom just, recently was inducted into the S&P 500 right before this whole debacle with coronavirus. That's, a little bit higher risk stock because they do focus on companies that have 5,000 employees or less. So they're working with a lot of small and medium-sized companies, and those are impacted much harder in a downturn, in a recessionary period. But it has been, if you look at the share price, the thing has been beat up really bad, and it does have hyper growth. It does meet the rule of 40, and I do like it long term. Zscaler, Adobe. Adobe is one of the best stocks, honestly, growth stocks that you can possibly buy. Shopify, it's a little expensive, maybe still here. I know that sounds crazy because it's been beat up, but I would wait till it gets under 300. For Shopify, I've got my list right here. I'm targeting to add more Shopify at 275. The lowest I see it going technically is 230. I hope it doesn't get there, but that's just what I see on the charts. Ringcentral, talked about this in my last video, or it's a top 3 growth video I just recently did. Okta, I have a video that's, which one should you buy, Okta or Ping Identity. If you're interested in Okta, you can take a look at that. It's like 25 minutes just on those 2 stocks. Google, of course, AI, YouTube, everything. CrowdStrike, this could have been on the spec side, but they've kind of proven themselves, especially with the work at home type economy and cybersecurity being such a big deal right now. You think of Zoom, getting hacked and things like that. I mean, companies like CrowdStrike are going to be really important moving forward. They are now, they always were. And it's, everything's just accelerated when it comes to this, SaaS and cloud and security type sectors. The Trade Desk, great growth company. MongoDB, so Mongo database. Alteryx, Square, Twilio. Alteryx is an interesting one. I don't own it. AYX is Alteryx. I probably should own it. I kind of go back and forth with it, and we have conversations all the time. Oh, it's too expensive. They burn too much cash. But then I did some Rule of 40 breakdowns, and it's actually one of the strongest stocks, and I don't own it. So I need to do more homework on that, and I might need to buy it. PayPal, have some of that, and I think it's going to be a good one long term. Tesla, you guys have turned me into a believer in Tesla. At this price, you're probably okay with Tesla. Could it go lower? Sure. But if you can get it under, honestly, if you can get Tesla like in the 400s, I think it's going to be $1,000 stock in 3 years, maybe more than that. I actually don't own any Tesla right now. Again, this is, if I were starting today, what would I buy? I would probably buy Tesla. I would have bought it at 200 if I go back in time. Teladoc, which has run a lot, but long term, I think it's still going to be a good play. You might buy this stock and it might get hammered and lose 20% of its value. But if you hold on to it, you're gonna be fine. So dollar cost average with all these, be smart. Veeva Systems, it's every time I look at it, it's even stronger. When you think of what Veeva does with biotech, they're really in the life sciences category, and biotech is doing so much work right now and needing so much help on the software infrastructure. Veeva is basically, software, for biotechnologies. It's very niche and doing quite well in this environment. Take-Two Interactive, video games, of course, Red Dead, Grand Theft Auto. They've got the NBA 2K. They're even doing a new NFL game. So we're getting NFL back. It's not just going to be Madden. We're going to have a 2K NFL game coming up. And then So ZG is actually Zillow Group, which I do not own, but look at the growth on that. It is a killer. Obviously, the stock price has been just decimated. I think it's actually a buy where we're at right now. I think we're down to like $30 a share. I think buddy of mine told me today that the fair market value is closer to 60. And I think there's a lot of fear because of the housing, being expensive and a potential housing bubble. So keep an eye on that. But I think if you bought Zillow in this range and held on to it for 5 or 10 years, it's probably going to be pretty good. It actually has the highest growth really if you look at just the pure growth over the last couple of years, it's one of the highest flyers in this whole group. Intuitive Surgical, robotic surgery is not going anywhere. NET is actually Cloudflare, which is another cloud security play. They also do a lot of CDNs, if you're familiar. But there's 26 stocks here, guys, and obviously, I said to pick between 10 and 25. You can pick the ones you like out of here. But if I were to start, fresh right now and had $100,000 or more, I would be looking at these growth stocks for my 40% bucket. And last but not least, the speculative bucket. So again, this is going to be, kind of roll the dice. They might go to zero. They might go up 300%. There's a few in here that you probably have heard of, maybe a couple that you haven't. So Virgin Galactic, that thing's been beat up really bad, and I think it's a really good spec stock to, buy a little bit of it. So if you look at the spec bucket, and again, if you have $100,000, you're putting 10% in spec. So you pick 10 stocks, you put $1,000 in each stock. Why not? There's no commissions anymore with any of the brokerages. So, you can buy as few shares as you want to. But so Virgin Galactic, I'd put a few bucks on Virgin Galactic and see what happens. Beyond Meat, Planet 13. It's a marijuana play. They've got a couple locations, one in Las Vegas, of course, Superstore, and they've got one that's just opening up here in California. Ianthus Capital Holdings, I think, has been beat up like all the pod stocks. Could go to zero, could go to $6. I don't know. Trupanion, take a look at that one. It's interesting. Pet insurance. Paysign. This is Green Thumb Industries, another marijuana play, pretty heavy in Illinois. VBIV, this is a vaccine play. It's a penny stock, and it has potential to actually get bought out. And there's a few other plays. It's been around for a long time, though, so it's one of those weird penny stocks that's been around since 1965. It gets pumped and dumped like all of them, but right now it's trading at like 90 cents, and it's probably, it's something that easily will go up to, probably $2. Could go to zero, but it's one of those bagger type stocks that you kind of, you buy and you just kind of let it sit there. If it goes to zero, you tax harvest it, otherwise maybe it hits a home run and goes up 500%. I like those kind of plays. Fastly, I've talked about Fastly a long time. That's another cloud infrastructure and CDN. They call it Edge Cloud. I don't even know if you really call it spec. This could easily be in the growth category. I think it's legitimate enough. It's been around quite a while. It was an IPO last year, but it's been in business for close to 10 years. It just was a private company prior. But I've got it in the spec bucket just because, it hasn't proven itself. And I've got Uber there too. You think of Uber Eats, and you think of Uber being, international. When we come on the other side of this pandemic, people are going to not use the bus and, public transit as much. They're going to use things like Uber and have, less people around them. So there you go. There's there's my kind of game plan that I would do if I were building a portfolio from, the ground up today. This is what I would look at. Hope this was helpful. It was kind of fun to make. If you haven't subscribed, please do. Please take a look at the other videos on the channel. There's, tons of other good information. If you like any of the stocks on here, I've got more detailed information on pretty much every one of these stock picks on my channel. So subscribe, take a look. Fired Up Wealth. You can take a look on Facebook. We've got a page as well as a private group. Just do a search for Fired Up Wealth. Thanks for joining. Thanks for watching. Appreciate your attention. Appreciate your support. Have a great rest of your day. Take care.